Hello again and welcome back to London. It's time to go back to Gekko Global Markets, where I've been speaking with Akshay Kapoor, and he's got some rather interesting views on what the Fed's been doing. Okay, Akshay, let's get straight into it. Last time I spoke to you was about Christmas time. You were predicting a not particularly good year for the equity markets. I think it was a 30 to 40% decline. We're up about 15% in the S&P 500% this year. So are we going to see a 45% collapse in equity prices in the last 6 months?
Well, it was a 20 to 30% decline, but let's not quibble about minor issues when the market's up 15%. Listen, that caught me by surprise as well. I have not changed my view on the fundamental valuation of the US equity market. I think as the rally gets stronger and stronger, I get more and more convinced that a big drop's going to come. I can't be sure of the magnitude, but I'm quite positive we're going to see levels of around 1200 again. Now, whether we see 1200 before we see 1750 or 1800, I don't know. But 1200 and below will be seen.
Yep.
I am absolutely confident about that.
I know what central banks have been doing, what Ben Bernanke's been doing goes against your economic principles, but in theory, he could play this perfectly, couldn't he? Because the fundamentals in the US are getting better slowly. We're seeing unemployment come down. If he does taper off this QE in the right manner, he could be a bit of a champion, couldn't he?
Have you ever driven a heavily loaded truck down a ramp? Big, long ramp?
I've never had to.
Never had to.
Yeah.
Well, listen, honestly, you often ask me, have central banks solved all our problems? And sometimes I'm tempted to ask a question back. Are you sure they're not creating problems for themselves? I really am not a believer that central banks can kickstart an economy. Right? The standard argument goes that if there is slack in the economy, if there is a lot of productive capacity, then you increase money supply, that creates demand, therefore that demand creates more supply, and then jobs are created and that kind of stuff is created. That's fine. I really don't think what we are in right now is a problem of demand that can be sorted out by monetary policy. I think a fundamental problem across the world is over leverage, so balance sheets which were fundamentally broken and they've been repaired to different extents, business models that needed to be restructured and changed, and the normal processes of a recession to happen. And what happens in a recession is that bad business models get destroyed. New creative business models come up. It's like a garden, right? You've got lots of weeds in the garden. You kill off all those weeds and new plants come up. That's the advantage of a recession, and we've never let that happen.
Yeah, but we have let this happen. We bailed out banks, but that doesn't mean other parts of the economy had that cushion. Okay, you can also say to a certain extent the auto sector in the US, but apart from those two sectors, surely that weeding out process has happened.
I don't believe so at all. I think a little bit of actually you're partially right. In the corporate sector, some balance sheets have improved. In fact, I would say almost half of the balance sheets have significantly improved. So that part is right. But what we've done is we have injected the system with a huge amount of liquidity, and that liquidity has found its way into asset markets, right? So if it was a question of demand, then what I would have done is I would have given a fiscal impetus. I would have substantially reduced taxes. I would have substantially increased expenditure. And I would always prefer reducing taxes to increasing expenditure. But I would not create new money, because by creating new money, what you're doing is you're channelizing all that money into the wallets of those very few people who are very close to the source of the money, which is the financial system, right? So what we've actually done is we made the rich richer, and we've really not done anything for the poor. This morning, I was just walking past our TV screen out there, and I heard this thing in the background from Bloomberg. How the super rich have increased global wealth, right? So global wealth is probably at an all-time high, but the proportion of that is with super rich is also at an all-time high, right? Income inequality is at an all-time high. And one of the reasons this has happened is because of monetary easing, because all of that money, all of that has gone up into inflating asset markets. And as a lot of people say, the Fed and other central banks have driven a wedge between the value of a company and value of assets and its prices. Value is here, prices are there. When the wedge comes out, problems will happen. And that brings me back to what I said earlier about the Fed having problems of their own. Can I ask you a question? What do you think the leverage on the Fed balance sheet is?
I don't know off the top
Take
of my
a guess.
head. There's no point me even guessing.
Take a wild guess.
You tell me, Akshay.
Lehman Brothers used to run a sort of leverage about 40 times. So a tier 1 capital of, let's say, 2.5%, yeah, at the peak. What do you think the Fed runs?
Probably less than 2.5% is my guess.
Yeah. The Fed have $55 billion of capital on their books. They've expanded their balance sheet to 3.24 trillion. That is, they've got a sliver of equity to support this huge castle of debt. And that sliver is 1.67%, which says that their leverage is 60 times.
But does it matter though?
Why not?
But why does it matter? If bond yields remain in check, they can rein in this liquidity.
All right. So you're basically saying that for eternity, bond yields will remain where they are. Yes, if for eternity bond yields remain where they are, that's fine. But assuming they have a 5-year duration and bond yields just move by 30 basis points, that's 1.5% over 5 years, their equity gets wiped out. Bond yields move anything more than 30 basis points, the Fed needs a bailout. And that is going to happen. Bernanke is going to be very lucky if he bails out right now. If he doesn't do this now, his successor will have a huge problem on his hand. He'll probably have to run to the government with a bailout. And then Bernanke would have achieved what a lot of central banks did not: destroy the credibility of central banks. Do you remember a chap called Paul Volcker?
No, I don't. No.
You know? Paul Volcker was the guy who was a central banker, chairman of the Fed for a long time during the 80s, who brought interest rates up significantly and killed inflation. Right? When I was in school, we were taught about Paul Volcker. And central bank independence started from there. That, listen, you need independent central banks so that they can keep inflation low. And if you keep inflation low, economies will grow. I think what our current central bankers have done is actually have put in the seeds of central banks' credibility destruction in place. At some stage, these central banks, especially the Fed, will need a bailout. The government will start interfering, and central bank independence will go down the drain.
And some pretty interesting views there from Akshay, which are actually quite hard to argue against. Anyway, that's all for the moment. From London, goodbye for now.